thought of the day. Today is January 19th, January 18th, actually, the Wednesday. 2 more days to go for this week to finish. And today we saw a reversal in the S&P for 4,000. It was just above 4,000 for a while, and then a couple of interviews from the Fed and from also from Morgan Stanley strategist Mike Wilson, and then with some bearish thoughts, and then we saw the market kind of went down below the 200 moving average, and it's actually currently resting around 39.30ish, which basically is saying that we again failed the 200 moving average, testing that, and 4,000 as well. Now here is a thought. The market was actually going up for the whole week, and this week Netflix's earning is coming up tomorrow, and Johnson & Johnson, but that's about it. Next week it's not going to be crazy, but the following week, next week there are some good earnings coming up as well, so we will see what happens there. And then following week you have Apple, Meta, and others. So I think the market is taking a breather here, and I think it's positive. I think it's actually healthy that market did not shoot up all the way before the earning, and then with the expectation going higher, then getting sold off after the earning. So what it's doing, this pause today, and I think it's going to continue for the week, and then maybe it will retest 4,000 after one of the significant earnings next week, and then we'll see what happens. But I would rather spend a lot of times in 3,900, at least about 10 to 15 trading sessions, which should be like first week of February, and then with a very low expectation for the earning, maybe shoot up, with the Apple earning just meeting expectation, beating expectation, and guidance not as bad as everybody thinks. If that happens, then I think stock has a lot of rooms to go for the next about 1.5 months, until again April, when we'll get some CPI data after China completely wakes up from their COVID shutdown for the last couple of years. So then, this is what I think is going to drive the market. So everybody is talking about, hey, like there are what do you say? There's a dichotomy, right? Like basically, some of the people are saying that material gold are going up because China is coming up, and then some people said, hey, inflation is going to come down at the end of the year, so Fed is going to reduce the interest rate or do a pause. Think about it. If the material price goes up, if the if you see a scenario where you'll have the oil is up, let's forget about oil, even the copper is up, silver is up, there are the overall materials, iron and others, XLV overall, the tracks the material is going up because China is back. What happens to the commodity price is going to go up as well, and which was actually depressed because of the recession fear for the last 6 to 7 months, and that's why the inflation went down quite a bit. Now oil, keeping aside the oil, this material price going up would cause the inflation to be up again, wouldn't it? At least for in the next 3 to 4 months, when this material price will show up in the in the factory data and in all the different food prices, etc. So I think that from between now and when that happens, the only one place everybody is saying don't buy technology, the leadership is gone. Now think about it. What else is out there apart from the technology? Is there anything else that you would buy in US market? What exactly is the US's, the USP? It really is the technology that it exports, and that's how, with a low dollar, and that's how the economy rolls. If there's if technology stock is down, I mean, think about it, like, the top talents, where are they located today? Most of this are in this very thin, it's right or wrong, it's a different story, but mostly in this technology sector. If you look at if a lot of people are saying, hey, maybe the Caterpillar will be the next big one. Maybe the materials would be the next big one, the leadership. I mean, leadership means what, right? So you can say that, okay, the market is flat, market is stagnated, so there is no leadership. So in that respect, maybe for a year or so, there is this materials and others are basically outperforming the tech stock. Okay, I can agree with that, but that doesn't mean that they're the leader, because there is not enough juice in those stocks, in those companies that will propel the American economy forward. It has to be the technology. It has to be the 4, 5, 6, 7, 10 stocks, the chip market, the technology market, in some respect, the car market, the Teslas and the Ford. So I don't think that there is an opportunity in the in the long run for the technology to go down, and this is how the market is going to play out. Okay, I think in the next 1 to 2 weeks we are going to consolidate again between 3850 and 3900, 3980, and once we have this tech earnings are up, then what we're going to see that the stocks are going to rally. The tech stocks are going to rally, taking the market above 243, 4400. Know this, that when we have an earning going down at the same year, we would have the PE up every time that happened, and this depends on the recession is deep or not. The earning, if further goes down, then we will have a problem. I mean, I'm not denying that's not going to happen, but in the next few months, I think it's going to be actually stock is going to be in a better shape. And then when we have a situation, then inflation coming back because of this material. I mean, I agree that XBI is a good buy, because XBI would cause this material, because of the materials price are high, is going to get higher. So this material stocks like the Freeport, the copper, and others, they will do well. If they do well, the XBI goes high. The XBI goes high, material goes high, the inflation goes higher, and China is back. Oil is a trump card. If oil goes higher further, obviously everything multiplies more, and more inflation comes back. Fed raises interest rate, and then we're gonna have recession or not, but definitely another pullback. And then I think in that scenario, I don't think people would see that the tech stocks, after the layoffs, after all the things that happen with the guidance, the risk reward will be much better for the tech stocks versus the industrial, which are way higher right now. In the last 10 years PE for the industrial and for the materials, it's actually going to the point where it's above the market PE. So I don't think that's sustainable. The industrials are actually trading at a higher multiple than the market. It's very unlikely that the growth perspective would be 20% plus, given the SOCs, the chips are coming back here, the new buildings, but what the infrastructure, the $1 trillion bills coming in, and now with the higher interest rate, with the $1 trillion of the debt. So now US government in the debt spiral, they have to print more money to pay the debt, and to print more money to sell those to sell those bonds, they have to pay higher interest to China and to Japan. And then again, there is a question whether China and Japan would actually buy US bonds or not, because China apparently is spending more of their US reserve, not by buying bonds, but buying oil and others. So basically materials, because there is a notion overall that dollar is losing its gist, and it's going to be material, which is going to be in gold, which is going to be more of a like a long term basically the reserve currency versus dollar. So dollar will lose its value, but not so fast. Between now and then, when it raises interest rates, Fed raises interest rate, dollar is supposed to go up. If dollar goes up, then the thought process that we can actually sell more bonds, the US government can print more money, that is going to be a inflation spiral as well as a debt spiral. So I don't think that infrastructure bill is coming. That would be disaster. So there is nobody is spending money on the US infrastructure, at least in the foreseeable future, until the interest rate goes back down, the inflation goes back down. I don't know whether it will happen or not. That's probably 5-year story. But between now and then, if there is no no infrastructure building on, in addition to this, the or whatever has been passed for the inflation bill for the SOC as well as for the energy, the low the batteries, and the clean energy. Nothing else is happening. So basically, for that, it doesn't make sense. The industrial stocks will go so high above the market multiple of 16 or 17. Whatever has been happened in the industrial is already priced into the stock. Next thing is going to happen, tech stocks going to get bought back. Not all tech stocks, but the SOCs, the chip stocks, are going to actually go in the market multiple because of because basically they are a good bargain, and the blue chip stocks, blue chip tech stocks, and the security stocks are going to go back again to reach multiples. And where the money is going to come from, because they're going to sell off the materials, sell off the not so much, I guess, material, but definitely the industrial, the discretionary. I think those are the ones which are coming down. So I think that is the playbook, at least for the first quarter. I think the earning, good or bad, but technology is coming back, and later on industry is getting sold off. So first 3-4 months, everything is going to, the broad rally is going to continue, and then once we have this inflation data coming in, there'll be a sell-off. But this time, instead of the tech sell-off, the others will sell off more. Tech sell-off is done. Tech sell-off right now, the tech should be bought. And once we actually, this process of Apple at 135, 125, and then the Meta around 120, 115, and Amazon around 90, Google around 85, then your Adobe around 330. These are the bottoms. Palo Alto Network around 135, crowdsource around 95. These are the stocks to be bought and to be made money in 2023. Don't go for the others which are already losing stakes.